What's up, guys? This is Sean and welcome to another episode of the iherng podcast. And it's almost the new year already, so before we end the new year, I think it's very important that we end it with a topic that has been neglected all this while. I don't think that many that actually touched this topic before. And this topic may be dry for some of the people because it's quite technical, it can get kind of boring. But I think it's very important to know which is the 5 different taxes you must understand in Malaysia before actually investing. So you will understand what are the actual costs of owning a properties. And I think some of the seasoned investors also say that, it's very easy to just like your net selling price minus your net buying price, so you get the difference, right? So that's how much you make. But if you want to go into real detail, really detail, the cost involves a lot of tax. So let's get into it. Tax number 1, which is the most highlighted one. A lot of people only understand this, which is RPGT. RPGT is the tax imposed on you upon you selling your property. So if you make money out of your property investment, there will be this tax imposed on you, and this actually change from time to time in accordance to the direction of the government. So the government wants to push property, then they will actually put it lower. I think this is evident in 2008, I think, when last time there was a time when the government really wants people to get involved in property. The RPGT was 0. That was the time where everybody was a property tycoon. Everybody just buy and sell, and there was no RPGT. So there was a time where supply couldn't meet demand. Then when the price get a little bit too crazy, then only the government start implying a lot of cooling measures, like, okay, now there will be RPGT for the first year after selling, second year after selling. So those are the times when if you have relatives that are older, right, these are the time where they buy before the construction was done, and after the unit completed, right, they can make almost a new unit one. Those were the days lah. So what many people do is after you sell the property, right, the lawyer will actually volunteer to actually calculate all your taxes for you, including the RPGT. But there's a trick to it. You can actually file it yourself because you can deduct out costs, meaning to reduce the tax. For example, I buy 400,000, right? So I sell 700,000. So I earn 300,000, and this 300,000 is not net, I still have other costs. So the cost involves like legal fees, agent fees, and repair costs. So the 300,000, right, maybe I can write off my agent fee load, I can write off my legal fee load, then maybe I can do some renovation previously to the building. Maybe I extended the kitchen, or I extended the front porch, or I need to fix up the plumbing system, right? All those can be deducted from the actual 300,000 that we made. So maybe it's like you left 200,000, let's say. So 200,000 only you are imposed with whatever rate depending on the year. So for foreigners, right, now the new act, and then you can find this information online anywhere, right, 2019 Malaysian RPGT tax, right, the bracket. So it's stated all there, and unfortunately foreigners now need to pay a rate that is actually higher than locals, but it makes sense. So a way that is not encourageable that you want to avoid this tax is you made no money out of the investment, meaning like when I buy in the SPA price is 680,000, but when I sell it's actually 650,000, so I actually lose 30,000, so I don't have to actually pay tax. But that 680,000, we all know that includes all the free lawyer fee lah, free 10% down payment lah, free cabinet lah, free this, free that already lah. So I think they still make money, just that on the SPA price, they don't make money. So besides that, tax number 2 you need to know is actually your income tax. So for those youngsters, right, I think for 2020, your focus now should be on getting income tax, meaning you need to reach a certain bracket to prove that you have income flow to your bank account, meaning like you are actually making money consistently and you pay tax. A lot of people try to avoid tax, right? So it's very common for Malaysian, right, especially those that is less educated. They try to avoid paying tax, meaning they declare a little bit, right? But this becomes a hindrance when you come to loan application. You need to prove to the bank that you have that certain income per year before the bank is actually comfortable to loan you money. So let's say a lot of people were like, oh, never mind ma, I can take out cash, I can buy first, then I take loan little bit lor. But the thing is the Inland Revenue Board, the LHDN, right, will then come and investigate that how in the world you get this 300,000 cash to pay up. And this applies to a lot of hawkers. Like I have relatives who are hawkers and then they try to avoid tax where they declare a little bit less. So they think that they are smart because they save by paying less tax every year. But it actually hinders their property investment journey. So now they want to take loan, right? They need to borrow people's name lah, they need income statement lah, they need pay slips lah, and things like that just to prove to the bank, right? They have this steady flow of income. Then another point where I don't think many will face yet lah, but for the property, those seasoned guru type of property investors, right? They are actually having this kind of problem. So I think some of the audience here, they own like 17 properties, 20 properties. Yeah, they do. They really own that amount of property. That's why the motivation of the channel lah. So some people own 20, but some of us, right, still struggle to own that one. So these fellow investors, right, have a separate problem where they now, when they sell, right, they sell too fast. When you sell properties too fast, you're making a lot of money. And then the Lembaga Hasil, which is the Inland Revenue Board, comes into the picture and says that no, now you need to pay income tax because the way you are buying and selling properties, right, is as if you are running a business. So RPGT, like let's say after 5 years, you pay 5%, right? We are already disturbed by it. But imagine impose 24% on your property gains because it's a business already. So I'm imposing business tax on you. And these people, the 18, 19 properties, right, they don't know what to do now. So the only way is actually pace out your selling, meaning every 2 years only you sell, or every year maximum you can sell one. You cannot sell more than 2 per year. Yeah, I know it's a whole different problem. Next, number 3 would be stamp duty. So stamp duty is the buzzword for 2019 because HOC campaign, which is the house ownership campaign that was launched by the housing government side, right? To ease a lot of young investors. So many don't even understand that after they get the keys, right, they need to pay this stamp duty one. And this stamp duty can be quite a big amount and it needs to be paid in cash, meaning it's around 2.5%. You can always find the tax bracket, right, online. So I'm not going to just elaborate a lot on this podcast. And stamp duty is actually paid by the buyer, and this is always during a transactional, or they call it instrument of transfer lah. Meaning when there's a transfer of name or transfer of ownership or transfer of a certain document from a person to you or you to another person, right, all those will be stamped. So this involves your SPA, your sales and purchase agreement, or your memorandum of transfer, your MOT, or even the execution of your strata title. And even your loan documents. I still remember those days when I have my first property, right, the Puchong one. I thought I pay this stamp duty already, I pay to the Inland Revenue Board already. I pay already. Then the bank still asks for another stamp duty. Like, why am I paying again? So there's 2 separate agreements. You need to have an agreement with the developer that you are purchasing this property, right? Or you're purchasing from a separate owner for sub-sales. Then you will need to pay another one for the loan facility. Meaning you need to tell the bank, I'm going to take this loan from you for the next 30 years. To buy this property. And how the value of this is determined is by your property price lah. And it's set like maybe the first 100,000 is 1%, the next 500,000 is around 2%, then more than 500,000 is the 3%. So it's a bracket kind of thing. It's quite easy to calculate. You can just go online and search all those. But in average, just for quick calculation, it's around 2.5 like I always take. Then the next 2 tax number 4 and number 5 will be the recurring tax. It means that when you hold the property, like you want to rent out for long term, right? These are the 2 taxes that you are supposed to pay lah. So number 1 is the property assessment tax. We call it cukai pintu. So cukai pintu is the door, right? So assessment, we call it cukai pintu. In direct translation is tax on door, meaning every house that has a door, there will be imposed of tax. And this tax is actually paid to local councils. So like for those in KL, you pay to DBKL. For those in PJ, you pay to MPPJ. For those in Shah Alam, you pay to MBSA lor. And the rates are different in accordance to your property type and your property price. So like for landed house, it's a different rate. For flats, it's different. For service apartment, commercial lots, all different lah. And why you need to pay this tax? So this tax is to fund the local council, right, to take care of all your infrastructure works like your street lights, your rubbish collection, your drainage system from the road, all the leaf drops, right, you need to sweep, all the landscape. Then your roads got pothole, they come and repair. And how is this calculated is based on a percentage of the rental collected, and this rental is determined by them lah. So let's say if I have a service apartment and my rental is 3,000, right? As this differs from local council to another, right, meaning the rates are different. So let's take DBKL for example. So DBKL for service apartment, you need to pay 7% of the rental collected per annum. So let's say it's 3,000, so it's 36,000. So it's around 252. Wait, 7%. So wait, 3,000. So it's 36,000 per year. So 36,000 per year, 7% is 2,520. Correct lah. So that's the rate. So if you are a landed, then maybe your rental is actually higher, but it's 4% on the landed. So for flats, it's lower. I think it's 1 or 2%. I forgot. And this differs from MPSA, from DBKL, from MBBJ, all different. And last of all would be quick rent, which is cukai tanah. And this is paid to the state government. Again, if your property is in Ipoh, you pay to Perak. If your property is in KL, you pay to the state. No, I think you pay to federal government. Then if you're in Selangor, you pay to Selangor state. Common question is like, if I have a landed strata title, do I still need to pay? The answer is yes. So in conclusion, let's run through all the tax again. We have number 1, RPGT, number 2, income tax, number 3, stamp duty, number 4, local council one, which is the property assessment tax, cukai pintu, and the last will be your quick rent, cukai tanah. So these are the tax you need to know to further tune your portfolio in your property investment. So these are the costs that you need to know prior to investment. So for those who have investing already, although this cost not be, I think the major one is RPGT, stamp duty. So for young investors, right, why you need to understand this is, first of all, you need to understand income tax, because whether you like it, right, you gotta have income first. So for those who have not or yet to afford one property, right, focus on increasing your income level. Whether you like it or not, you need money to buy, or you need proof that you have money to buy, and that proof always is income tax. For a person who pays like, let's say 36,000 per annum, suddenly you are buying a 500,000 house, no bank is going to loan you money, right? So after that, then when you plan your exit plan for your property, the RPGT comes into play, then the stamp duty comes into play. If you're holding your property long term, then the two other, which is your cukai pintu and cukai tanah, your land assessment and your quick rent, then you need to consider what are the rates annually, but those are not as hefty lah. So I would say it's pretty okay. So I think that's all for this episode. I hope you guys gain something out of it, and if you really like this video, like it, share it, and even subscribe. For more information, you can actually reach me at any social media at iherng, and I'll try to answer as many questions as possible. Until next time, this is Sean Tan. Happy New Year. Ciao.